PwC analyzes the results of the big four banks in South Africa by aggregating the public announcements of their results with a view to identifying trends with which to inform market participants. For the first 6 months of 2013, we saw headline earnings up 11.5%. That was driven by an increase in operating income of 9%, well-managed costs only increasing by 6.6%, and bad debt impairment charge up 6.7%. That gave us a combined ROE for the four banks of 16.1%. However, we did see some differing ROEs amongst the big four. The income growth has been driven primarily by increased margin. That has come off the back of increased lending by all of the banks, primarily to the corporate sector, as corporates appear to be lending or borrowing again, and banks appear to be lending in the longer term now that new regulations have been implemented and they can appropriately price for them. We've also seen some changes in the asset mix, with continued focus on higher yielding assets and good growth in those loan portfolios. Non-interest revenue is up 6.4%, primarily off the back of increased trading volumes in the customer flow space, increased customer numbers, which has increased transaction flows for the retail customer. Impairments are up 6.7%, which is higher than in the prior year, but not at levels that we've seen in the past, such as 2009. Bad debts appear, or non-performing loans appear to be well covered and are at historical levels in terms of coverage ratios. Operating expenses, as I said before, are extremely well managed. The 6.6% growth has come in the form of an increased salary bill and investment in new technologies. What we can conclude from our analysis is that our banks are well managed, are focused on their primary markets and growing their customer base and doing what they do well, whilst at the same time looking for new avenues of growth and areas within which they can take their businesses forward.